But let's welcome on board Rajiv Lochan. He's the MD at Sundaram Finance and try and figure out how their business is looking like. Rajiv, hi, good morning. Welcome to ET Now. Rajiv, just wanted to understand what's the macro environment for you right now, and perhaps you'd have a better lens about both the government's push on infrastructure and the kind of revival that is expected to kick in for the CV cycle.
Thanks for having us on the show. Much appreciated. I think medium term, the India story is looking quite good. Near term, I think we're off to a pretty good start as a sector for the financial year. Q2 tends to be a little bit slower, just given monsoons and the attendant complications that come with it. But to the specific questions around the M&HCV cycle, construction infra, I think all those are looking quite good at this point. The infrastructure push is steady and sustained for the long term. So all sort of asset classes under that, whether it is at the tipper end of the segment or excavators, backhoe loaders, and more sophisticated construction equipment, there's pretty robust demand. So much so that there's actually demand for these overseas as well, and that's something we're trying to tackle, where assets get bought here and get smuggled or shipped out overseas, which is a big risk issue that we're grappling with. But on the M&HCV side, through COVID, we've come to a bottom of the cycle, and now we are firmly in the lower end of the upcycle. And our sense is over the next 2 or 3 years, we should see sustained growth in the M&HCV space. Economic activity is tracking quite well. All the leading indicators we're looking at, diesel consumption, e-way bills, and so on and so forth, point to sustained and steady economic activity. And going into the festival season, which is always an auspicious time across the country, across different customer segments, we expect the optimism and confidence to continue through Q3 as well.
So you are so upbeat. I wanted to understand what is it that you hope to clock in terms of AUMs and disbursements, as well as what your target would be for FY24. Because even in the first quarter, which is seasonally weak, your numbers managed to beat the street estimates.
As a matter of practice, we've never given any guidance, and I prefer not to start a new tradition just now. I will just say that we prefer to ensure that we retain the market share that we think we rightfully deserve, and where we can extend it a little bit. Our focus tends to be on serving the customer segments as best as possible and ensuring that we are taking care of our people as best as possible. If you look at the long term, over long periods of time, we've grown between 15 and 20%, pretty much any metric you look at. And in a sense, that's the long-term aspiration for the company, to remain steady, consistent, marathon runner type of biorhythm that we would like to ensure, which has been our heritage, as I'm sure you're aware, and that's the heritage we would like to further as well.
Rajiv, you're one of the few NBFCs which are trading at 52-week high, by the way. So market is loving what you're doing. And that too at a time when almost half of your portfolio is at the troughing out phase of the cycle. I want to talk about where in the cycle is the rest of the half of the portfolios, cars, farm equipment, construction equipment, that part. Because some of your peers are clocking good numbers. What's the visibility there?
Yeah. Passenger cars, I think, is a long-term consumer story. I think as India moves towards being a middle-income country, I think the natural shift towards passenger car ownership is continuing. And we're seeing that quite systematically in the last few years. Coming out of COVID, we've seen sort of record numbers as far as passenger vehicles is concerned. The other trend I'm sure all of you are also tracking is the shift towards the higher segment cars, C and D segment cars, as well as utility vehicles, which again speaks to sort of the aspiration and affluence levels within the country. So our sense is passenger vehicles sees a steady, systematic kind of trend looking ahead the next few years. Tractor and farm equipment is a very interesting segment. Our own sense is the government is remarkably sharply focused on ensuring rural welfare and farm incomes more than double. I think the Rural Revolution 2.0 that is now underway is very real on the ground that we're seeing. Consequent to that, there's a fair bit of mechanization. So it's not just tractors where we're seeing steady and systematic growth. We're also seeing in farm equipment and broader mechanization of the agriculture space that's gaining traction. Interestingly, I think related allied agri segments like dairy and so forth are also seeing a fair bit of traction within the country. Today, we are the largest producer of dairy in the world, and I think we have a long runway there. So I feel tractor farm equipment and related segments have a long runway for growth and prosperity. Construction equipment, like I mentioned earlier, I think this is a multi-year journey that the government has committed to and is very firmly implementing. And on the back of that, we are seeing across all the sub-asset classes pretty significant traction that's happening. I think metro construction, for example, in the metro areas is really peaking now, and that requires fairly sophisticated equipment, whether it is tunnel boring machines or other types of equipment to set up, pillars and so on and so forth, piles and so forth.
Sure.
So fair bit of traction, I'd say, on the infrastructure space as well.
Sure, fair bit of traction on the infrastructure space, Rajiv, but you have also forayed and looking at getting deeper into the affordable housing segment as well. Talk to me about what could be the mix in the overall pie, let's say 2 to 3 years from here on.
So our affordable housing foray happens out of our 100% subsidiary in Sundaram Home Finance. They have a judicious mix between housing, loans against property, and construction finance. And a natural extension to that is the affordable housing segment. We tend to be relatively strong in the southern markets, particularly as you go deeper into the southern markets, tier 2, tier 3 towns, we tend to have a pretty strong presence. So affordable housing is very much one of the strategic drivers within our home finance subsidiary. And we see that also as having long-term legs. And that will steadily grow as a mix of our portfolio.
And could you also talk to me about what your outlook is on the cost of funds, how they are likely to move, and the NIMS on account of that?
Sure, I think it's a billion trillion dollar question. If someone could just give us a sense for how that is likely to pan out, I think that would be most helpful. Our own sense is the regulator is truly grappling with a very complicated challenge. As inflation spikes and cools off, they have to take a long-term view to how to contain that. At the same time, currency needs to be managed well. So our sense is looking ahead, unless there are some significant global forces, for example, the Fed or other central banks overseas, significantly raising rates to cool inflation. Our sense is, the basis for further rate hikes is limited. And consequently, we think we've sort of reached the peak as far as the repo rate hikes are concerned. Our focus is very much being AAA rated on ensuring that we get the best cost of borrowing from a diversified set of lenders and transmit as best as possible. What we've seen through the last 2 or 3 years is a widening of margins, certainly for us, but also for the system as a whole, largely because I think of the COVID accommodation that the regulator and the government provided. Subsequently, now as things have settled, we are back to pre-COVID margins, both in the system and certainly for us. And we think we'll now begin to operate in our long-term corridor of NIMS, which has typically been in the 4.5% to 5% kind of range. That's where we think in the medium term we will settle down in.
Okay, so 4.5% to 5% kind of NIM margin. And before I let you go, Rajiv, yesterday we were also discussing with IMD how the monsoons have started withdrawing. There's still a deficit of almost 6%, and it's been very patchy. Are you worried about the asset quality? Because there were some of the analysts and brokerage community who were talking about the stress that could come on the book on account of that.
No, I think that is very much a monitorable and a key monitorable, I would argue. I think monsoons and the attendant complications that you characterize quite well are very real. In some places, we've seen a significant excess. Places like Punjab, Himachal have been ravaged by rains. Others are substantially lower. I think many segments of our customers have actually lost a crop in some places. So, it's a complicated situation, and we'll have to see how we work through that. Not just that, as we get into sort of election season across multiple states, I think typically what tends to happen is, some spending gets front-ended, but also payments get delayed, projects get rethought. So there is, over the next 6 to 9 months, I would argue, sufficient basis for us to remain watchful on payment delays, contractors delaying payments, working capital pressures, and as a result, tightly monitoring asset quality and ensuring that collections and recovery is on track. So it's not all hunky-dory. The medium-term story for India is certainly robust, but in the near term, as we navigate both geopolitical, macroeconomic, weather-related challenges and some of the regulatory challenges that our regulator is faced with, there will be near-term challenges for us to grapple. So I want to leave a very balanced picture for you guys.
Okay. Great to then have you on the show, Rajiv. Thanks as always for taking the time out.
Thanks for having us. Take care.